talk to everyone and basically teach you all a simple concept, a simple calculation that you can do yourself to determine what your FIN number is. So for those of you who don't know what a FIN number is, FIN, F-I-N, stands for Financial Independence Number. And what that number is, it's your retirement number. It's how much do you need to have in order for you to retire and stay retired with dignity. And so I want to go over a couple of key points. The first one is to teach you what's called the Rule of 72, which is essentially compound interest over time. And the second point is the 3 key variables that could potentially affect or that will affect your retirement if you don't take it into consideration. So I'm going to go over that. So let's start very first. What I want to go over is typically the age in which someone starts to really truly take seriously, saving for retirement is usually between the ages of 30 to 65. So we're giving this individual in this example 35 years to save for retirement. Okay, now the first thing I want to talk about is how do you determine how much interest I need to have to make sure my money is going to grow and compound in order for me to get to this particular number, which we're going to show up in a second. So first, Rule of 72. How do I figure that out? Very simple. Let's say you were saving in a bank and the bank was giving you, let's say in a typical CD account, anywhere from 0.5%, so half a percentage, up to say 2%. Well, let's just take, for simple math, we're going to go with 1%. Rule of 72 states that if you take the interest that a financial institution is crediting your account and you divide it into 72, this will give you the number of years that it will take for your money to double. So in this example, let's just take $10,000. So you take $10,000, okay, it's going to take 72 years for it to double to $20,000. Not fun, right? It's going to take forever just to get that extra 10,000, right? For it to compound over time. So the idea is wherever you have your money, you need it to double. One reason, which is a key variable here, is how it affects your retirement, is the rate of inflation, or in other words, the cost of living. For those of you who don't know, the rate of inflation is 3.22% per year, which means that your lifestyle is going to cost you double in 20 years. Okay, hope that makes sense. So let's say if you're accustomed to living off of $50,000 per year, fast forward 20 years later, okay, it's going to cost you, for the same way you live today, same neighborhood, same groceries, same gas, everything is going to cost you double. So you need to make sure that in 20 years, you're making at least $100,000 to keep up with the rate of inflation, to keep up with the cost of living. Hope that makes sense, okay? So now, that's the first variable. So now that you know that you have to have a certain amount of interest for your money to double over the course of your working years, that's called your wealth accumulation years, let's do the second math, which is here. So if you right now are good with making $50,000 a year, okay, and you can live off that comfortably, double that, so in 20 years, you're going to need at least $100,000. Okay, so basically taking this and putting it up here. $50,000 to $100,000. Now, at $100,000 per year, right, if you reach the age of retirement, how long do you think you need to have your income for? Probably up to the age of at least 85 years old, right, with the average life expectancy is anywhere from 83 to 86 years old. So if you need it, let's just say, simple math, 20 years. If you take $100,000 and you multiply that by 20 years, that equals $2 million. So by the time you reach the age of 65, you need to have $2 million in some kind of an account that has grown and compounded over time. I'm not saying you have to save yourself $2 million, but whatever vehicle you're using has to be able to equate to $2 million. This is your destination. Okay, So now what we're going to do is we're going to talk about the reverse rule of 72. So I just shared with you the rule of 72 that determines compound interest. Now we're going to reverse engineer this to show you how the math works when it comes to saving and determining if you're actually saving enough and is your money growing the way it needs to in order for you to reach this magic number of 2 million. Okay? So, we'll be conservative with this math. So let's say that your retirement plan, whatever you have your money growing in now, is going to grow over time an average of 6% per year, okay? So let's take the 6% and you divide it into 72. That's 12 years. 12 years. So your money has to double every 12 years in order for you to get to 2 million. Now we're going to reverse engineer this. 65 minus 12 years, we're using this number here. 12 years is 53 years old. So at the age of 53, you have to have half of this number, which is 1 million. Okay? 53 minus 12 is 41. Okay? So you have to have half of this 1 million, which is 500,000. Okay? I'm sure you probably hear my daughter in the background. That's little Leilani giving us some trouble today. 500,000. Okay, now 41 minus 12 years puts you at age 29. At the age of 29 years old, you would have had to have half of this number, which is 250,000. Now let me ask you all a question. How many of y'all today, at the age of 29, or maybe you're in your 40s, have ever crossed these metrics? Are you right now 41 years old and you have $500,000 in potential income for retirement that will take you to the $100,000? Do you see where there's a gap in saving? There's a gap in growth. But here's another thing that impacts your retirement. The second variable is taxes. Most people are saving where? In pre-tax vehicles, which means that when you're 65 years old, doesn't necessarily mean that your tax bracket's going to be lower. Let me make that very clear. Does not mean that your tax bracket automatically is going to be lower. Guess what? You don't have anymore at the age of 65. You no longer have the tax deductions that you have today while you have dependents. That's number one. Number two, you've likely already paid off your home, hopefully by the time you retire. That's usually someone's goal, right? At the age of 65, you no longer have that tax write-off. So you're now limited as to what you can write off on your taxes, thus adjusting your gross income, right? So your tax bracket may not change in retirement. Let's not count on that. In addition to that, right now what we're experiencing with the pandemic, they've had to use, right, a stimulus package to be able to stimulate the economy, or at least in hopes of stimulating the economy, to where do you think the taxes are going to go for the middle class? They're likely going to increase, right? So all you're doing is you're prolonging the inevitable, right? You're going to be paying more in taxes later on, which means that this $2 million can be very easily be cut in half to 1 million instead, right? So that's the second variable. The third variable is health changes. How do health changes impact retirement? Well, it's very simple. The average age in which someone needs some kind of critical long-term care, it's usually between the age of 60 to 65. That's when it all starts. So if you're already reaching retirement age at the age of 60 here, and your health is already declining, and you're needing some kind of long-term care, well, that's going to eat away at your retirement, isn't it? Right? So that's another thing. Health changes. We have to consider that. We have to make sure that we're protecting ourselves from that. So in essence, once again, it's all a math problem. You want to make sure that you're saving the way you're supposed to save, to ensure that you're not going to be in a major hole when you retire. The idea is that you reach your mathematical goal. You reach your destination when you're going into retirement. You don't want to also, which ties into the third point as well, these are both losses. Health changes is a loss. Stock market is a loss. If you're here say you're here, let's say you're 56 years old, and the stock market, like it has been, has taken a dip. Where do you think it's going to leave you? Is it going to leave you closer to your 2 million? Or is it going to leave you a little further away from your 2 million? Likely away from your 2 million. Reason being is because it all losses in your retirement portfolio is dependent on when it happens. If it happens here and you're, say, 25 years old, right, do you have time to make up for the losses? Absolutely, because you're still in your work. You're still able to save, right? But if it happens here and you lose 25% of this 1 million, you've just lost 250,000. How many years did it take for you to save this 250? Does that make sense? So this is why it's so important to understand, number one, how compound interest works. Number two, the key factors that can potentially affect your retirement that will essentially leave you in a dead end, not even having enough money for retirement. So I hope this information was super valuable to you. If you do find this content valuable, please like, share, and comment. Definitely subscribe to my YouTube channel. Hey, thanks so much for watching. I do have a free giveaway for you called the 10 Things to Consider When Purchasing Life Insurance. Just click on the link below.